Basically, I'm here to talk about financials globally, and we run a series of funds, probably the most prominent financials opportunities funds. And I mean, financials are topical all the time. You open the paper every day and it's just full of news, good and bad, about what's going on in the sector. So it's still very much of the moment and it's still very topical. I think what is interesting right at the moment is probably the issue that in the current sell-off that's going on, they are outperforming, and that has not generally happened. And that's a beginning of an indication that maybe investors' attitudes to them are improving. So in a sense, the whole point of me being here is to give people a slightly broader picture than maybe what they're seeing at a national level. Sometimes the problem for regulators is trying to sort of balance a sort of rigorous approach and actually keeping the banking system safe. So in the sense, they don't want a panic to happen if any banks are actually in trouble. But this time around, the evidence coming back from the bank managements, it's a lot more rigorous, because it's not just do you have enough capital, it's can you withstand various stress tests that are coming through. So I don't think in reality many banks will fail. It's likely to be periphery banks. I mean, quite topically, it might be sort of German banks, etc., some of the state-owned banks who could be affected. But some of the bigger quoted stocks have already raised capital over the past 2 years. And I think that's the key thing about the sector. Sentiment is often quite negative, but actually balance sheets have improved enormously. And it's particularly important for Europe because European financials or European banks are some of the cheapest stocks you can buy globally. So there's that sort of balance of value plus perceptions maybe being 2 years old rather than the reality at the moment, which is actually much stronger balance sheets. When they are cheap and when they have enough capital, they buy back. And you have great evidence of that happening in the US. It's been happening for 2 years now. And that is a core belief of ours, that they will have surplus capital within the next couple of years, because we've already seen evidence of that. Now, in terms of will regulators go for them in a different way? Could we have all governments will go for them in terms of special taxes, et cetera, et cetera? I mean, it's happened very selectively. So somewhere like Hungary, for example, has been sort of at the forefront of using that approach in terms of taxing the banks at a higher level, et cetera. But in the main, I think most governments and regulators are very aware that the banks are an intricate part of the recovery that everyone wants. So if you tax them and they need more capital, they're less likely to lend, etc. So it will upset that whole process. But I think one of the issues you've got to remember about lending is that it's not, okay, the appetite for lending is probably less from the banking side, but it's also the availability of reasonable investments for those loans. A lot of the demand for new loans is just not there. So the press likes to portray a picture that there's loads of SMEs desperate to get funding and they can't. But in reality, the reality is most banks do actually want to lend because they're earning hardly anything on their liquid funds. So they do want to lend. I think the other issue is that from our perspective is if you look at the US, where the balance sheets have essentially recovered, you are beginning to see a growth in loan books in a way. So their loan books are running at about 6 to 7% in terms of growth. So that's the beginning of a more sort of sustained recovery. I mean, the banking system is quite a good way of looking at how strong the general macro picture is. Because at the moment, a lot of things are quite distorted because of interest rates. So. I mean, it's a very sort of exciting space for the sector because things are changing. I would say it's too early to say that incumbent players, i.e. the banks, are necessarily the losers in terms of what's ahead for us, because it's quite clear technology is coming into banking in a much more significant way. The distribution of products is increasingly over the internet rather than through a branch. But there's two sides to that whole thing. On the one side, it could mean that the banks don't need as many branches, so cost structures could materially change. I mean, branches and employees are their biggest costs. On the other side, it could be that you might have newer, smaller, nimbler banks or other technology companies which take share. I think the debate has probably moved too far. It's early days in that process. The one segment where it's happening quite dramatically is in payments. And actually, I wouldn't say that is necessarily the core product. The risk is more to people like MasterCard and Visa, etc., if there's alternative means of payments. But Interestingly, Apple, when it introduced its payment system, decided to use the incumbent players rather than set up its own genuine separate payment system. So I think it's a very exciting space, and some of our funds, have some exposure to that. But often there's a simpler way to play it. Just buy new small banks which have recently quoted, and they're putting in a lot of their technology up front. So you're getting the growth, you're getting the benefit of the technology, and it's a sort of business model which is much more, well, first of all, it's profitable, because a lot of the technology companies are not profitable, and it's much easier from our perspective anyway to analyze it.